fourth session with Uma. I will not introduce her every time because I'm seeing most of the people are the same people who are joining the session every time. And it is an interesting topic this time that we have. It is index and passive investing. I think that is the way the investing, I think, eventually will happen in India also. So I think, Uma, let us first hear you out and let us see that if we can do more of question and answer session also, if we have that.
Sure. Yes,
Yeah.
yes,
Yeah.
yes. That
Thank
will
you,
be a
Uma.
good thing.
Yeah.
Thank you.
Thanks.
Thank you, Sangeeta. Good evening, everyone. It's a pleasure to be able to connect with you every month and to talk to you about a few topics. This time we have decided to change the format and devote an entire session to a particular topic, and the topic that we've chosen is passive investing and indexing. After a very, very long time, I think the interest in passive investing in India in the last 6 months has been really high, which is a good sign. So let's talk about what the product is and how does one look at indexing. Okay, so I'll begin with this whole idea of index correlation. Okay, now whenever we are looking at the market, at the equity market, okay, and we are asking about how is the market performing, what is the kind of return that is available from the market, when we ask these questions, what we find is that picking up a few stocks, okay, and building a portfolio will largely reflect the overall direction of the market. Or in other words, the market has various stocks. However, its overall direction is to a large extent determined by the very large actively traded liquid stocks. So if you build an index and if you picked up, let's say in a market with thousands of listed stocks, if you're able to pick up 30 stocks or 40 stocks or even 50, you're able to capture the overall direction of the market. What you will find is that any portfolio that you build, any portfolio, you can have your own portfolio, you can have portfolios built by fund managers, portfolio managers. Any portfolio that you build will show a very high correlation to this index. Now, for example, if you went and looked at, I'll just share my screen and show you for a minute. Not sure. Just give me a minute. Okay. You're able to see, I mean, I've just picked up any fund. If you see here, this is fund performance versus the index. Now you're very familiar with how these graphs look, okay? You can pick up any equity fund and look at long-term returns of this fund over a time frame, and you will pretty much find directionally as well as magnitudinally this correlation. The correlation is fairly strong. So that's the first principle to remember. It is pretty much difficult to create an equity portfolio that is uncorrelated with an index. Okay, that's the first idea. So however you try to construct a portfolio, it will run pretty much in the same direction. The differences will not be, the difference in performance will be there. We will talk about it, but not be too much, in a sense that When you talk of an index, you are talking of the overall direction of the market or the essence of the market or capturing, which is why we call it as the market portfolio. And we also keep the index as the benchmark portfolio. So, which means that the moment you have an index in the market, you're capturing the overall direction in the market, right? So, that's the first idea, which is why we have the index. You have a few stocks and you're able to capture the overall direction of the market. Now, there are various indices that have been created. The Sensex is there, the Nifty is there, and there are mid-cap indices, large-cap indices, and so on and so forth. Now, even if you were to take the top 500 stocks, the point to remember is the dominance of large cap. So, a large cap is so large that it has to be present in every portfolio. You know, for instance, if you looked at an equity portfolio that is managed by funds, very difficult for you to find a portfolio which doesn't have the very large cap businesses. Now, of course, the SEBI definition, that we'll come to the SEBI definition in a minute, but broadly, the presence of very large companies tends to create a skew in their favor, right? So, performing portfolios tend to hold these large companies, which also get into the index. So, if you look at the index construction is largely driven by liquidity. For instance, if you looked at Nifty, Nifty has a internal calculation, where you're looking at stocks which are most frequently traded, and they have a liquidity monitor which is looking at the most liquid stocks, and the 50 stocks are the most liquid stocks on the National Stock Exchange. So any changes to the Nifty will come primarily from any changes to liquidity of stocks. So actively traded large companies. So these end up being business leaders. And therefore, the index becomes representative of the leaders in the market, okay, which is also the reason why it is a benchmark. From an investing perspective, okay, what happens is that there are two components to return. Okay, the way we look at return from a portfolio, equity portfolio. The first part is what we call as the beta return or the benchmark return, and the second one is what we call the alpha return. Okay, which is the return that is added by the fund manager. Now, the benchmark return or the beta return is what the index will deliver. Now, this return, the beta of the index is 1. Okay. Now, the index is a benchmark, which means that if you didn't make a plan, if you didn't make fund selection, if you made no market timing decision, when to get in, when to get out, you did not make any selection of stocks. You also did not make any selection of how much will be invested in which stock. You didn't make that decision either. Then if you did this, then the kind of return that you will earn is the index return. Now, this return is also called the beta return. So this is the benchmark return that you will get, or this is also the asset class return. So if you say, what is the return from investing in equity? Now, we have over 40 years of data, 45 years of data from 42 years of data for Sensex, for example. If you see the long term, the 42-year return, we have a CAGR which is close to 16%. So we call that as the benchmark return that is possible. So if an investor says that I would like to earn the benchmark return without having to make a call on which stock, how much, when, if you invested in the index, this is the return you would get. So the index offers, that's its biggest merit. The biggest merit of an index or a passive investing is that it makes no calls of any kind about stocks, selection, timing. Okay, there is a ready-made portfolio which is available, and you invest in this basket. And it's a benchmark return. We call this the beta return because this is the return for investing in the market. You're not going to apply yourself at all about any of these factors of portfolio management. When we say alpha, managers alpha, alpha refers to what the fund manager is able to add over and above the index. So if you looked at, for example, some of the funds with track records of 25 years plus of presence in the Indian markets, you will find that many of these funds boast of a return which is higher than the 16% provided by the market. Okay, there have been funds that have posted 3 to 4, there's some 4.5% of alpha. Now, if you return which is over and above the index, now that's the case for active investing. And if you take away the expense, let's say the expense is about 2.5%, even if you took that out, there is a surplus that is available. This is called the alpha. So when you pay the fund manager the 2% for managing the portfolio, you're asking the fund manager to take the call on which stock, which sector, which or how much weightage, when. When will he invest in a particular sector, or when will he not? Okay. Now, so that return is the alpha return. Clearly, it is important to understand that when you are indulging in passive investing, you will give up alpha. You will say that you don't have to be a believer in all of that. That's a different story. Okay, we'll come to that story. You don't have to be a believer in this theory that no fund beats the market and all of that. That theory is wrongly positioned. We will talk about that. But if you believe that I do not want to go in search of the fund manager's alpha, I don't want to be bothered with selecting funds or selecting stocks, then the index will offer you what is called the benchmark return or the basic beta return. Okay. Now, whether you will earn an alpha or not is another question. Okay, so that is the idea of index. What could be the problem with, or what could be the issues with trying to index or trying to be this passive investor? So when we say passive, it means that you don't make these calls, right? You just follow a benchmark index. And when you make an active call, your objective is to be able to provide additional return. Now, having said that, let me show you where the limitations will be. Let me switch. Okay. I'm showing you the Nifty. All right. If you see the Nifty here, I'll draw your attention to both of this. Now, if you see here, Reliance and HDFC are over 10% of the portfolio. Now, we know that a fund cannot hold more than 10% in a stock. So whatever the name of the fund, it's not going to be able to replicate, except if it is an index fund, it's not going to be able to replicate this. The actual holding of the fund can be different. There can be stocks which are apart from these 10 stocks. But more importantly, look at this composition here, right? The Nifty as it stands today is extremely overweight financial services. Why? Because the most actively traded large stocks, as I told you earlier, the index construction does not care about which sector. It just looks at which are the top liquid stocks. So in its construction today, the Nifty holds a disproportionate amount in financial services. We call this, it's about 40%. Okay. Now assume that a fund manager holds, an active fund instead of putting 40% in banking, holds about 20% in banking, just for the sake of argument. Let's say the fund manager is holding 20%. So this means the fund manager has underweighted financial services. Compared to the index, he's underweight financial services. Now, what will this underweight do? This underweight may generate an alpha for him if other sectors do better than the banking sector. But if the banking sector continues to outperform, what will happen? The fund manager will underperform. You get what I mean? Because the index, by virtue of 40% in banking sector, will offer a certain kind of return. And the fund manager, because his portfolio is not exposed that much to the banking sector, will begin to underperform. So fund manager performance to a large extent depends on these two compositions. That is, what kind of sectors is he overweight and underweight, and what kind of sector stocks is he overweight or underweight. Okay, so he might still be holding financial services, but within financial services, he may not hold HDFC, ICICI, Kotak, and Axis in that proportion. He may not have so much money. For example, he may not have 10% of the portfolio in HDFC Bank. He may have only 6% in HDFC Bank, for example. So if his percentages are different, it is. But there's also another point to remember. Replicating the index might be difficult for other reasons. Consider, for example, the oil and gas. Now, you looking at VPCL, HPCL, GAIL, and ONGC oil. So very much possible, given that these are, there is a commodity element as well as an oil marketing element here, and the way oil prices are regulated, very rarely will you come across active fund portfolios that hold so much of oil. And the index is also somewhat heavily skewed towards PSU holdings, which the fund managers are not likely to have. And you will find that there are sectors like metals, sectors like telecom, sectors like power, fertilizer and pesticides. These are sectors, these are co-sectors as we call them. They form a small percentage in the index, but active portfolios may or may not hold this sector. Okay. So replicating the index or holding the index comes with these limitations. It's important to remember this. If you're a passive investor, and if you're at this time invested in a Nifty index fund or a Nifty ETF, this is what your portfolio is. Your portfolio is heavily weighted towards financial services, IT, oil and gas, consumer goods. These are your top holdings. And you also have exposures to metals, fertilizers, power, telecom, and others. So it's important to remember that how your return will behave, how an active fund will outperform or underperform will depend on how these sectors are performing. Not so much the stocks, because these are all top stocks, but the sector weightages to a large extent. So when you're looking at a large cap fund, when you're looking at a flexi cap fund, when you're looking at an opportunities fund, when you're looking at all of these funds, their performance to a large extent is driven by what kind of weightage they will have. Now, we said this very clearly. Now, this changes in weightages can lead to outperformance. It can lead to underperformance, because if the fund manager is both ways, it can happen. Fund manager is underweight something. He's not holding enough of, let's say, banks, and bank stocks are running. Fund manager will underperform the index. Fund manager is underweight, but the sector has dropped. Fund manager is not holding telecom. Telecom stocks have crashed in value. The fact that fund manager is underweight will lead to active returns there, because he would have protected the portfolio from such losses. So building alpha comes from doing this and not being a passive investor. Now, why should you then be a passive investor? What is the case for being a passive investor? The primary case for being a passive investor, I've already made. You can run and do whatever you want. You'll ultimately look like the index. Okay, might as well buy the index. To create any portfolio, that portfolio will largely look like the index. Okay, it will not look significantly different. First case, it's a default portfolio. The second case is this, that all of these activities of changing the weightage, changing the industry composition, changing the stocks that are being held, all of this, will they lead to an alpha or not? Now, in many cases, they do. Okay, there are enough cases of fund managers performing better. But the problem is, all this changes can also lead to underperformance. So if you looked at funds as a whole, I'm talking of all active funds. If you looked at funds as a whole, what you're likely to see is that the average, again, the same thing, right? If you looked at all of these portfolios together, they will begin to look like the index. So you bring them all together, they will all pretty much run like the index. There won't be much of a difference in their performance and the performance of the index. And if you brought in the expense ratio, you will find that funds have underperformed. This is a very highly cited research which says that active funds do not outperform their benchmarks. What you must remember is that's the average. So you have to interpret that research carefully. That research is only talking about all funds. Why is that number an underperforming number? Because of the expense ratio. Because when you bring in all funds, you're bringing performing funds and underperforming funds together. So what is the nuance here? The nuance is there is always some fund which is doing better than the index. Always. There are always a bunch of funds that are doing better than the index. But there are always a set of funds that are doing worse than the index. So when you bring it together, it becomes averaged out, right? So what does the question lead to? It leads to the question of fund selection. More than the fund manager selecting the stocks in the sector, from an investor's perspective, it's about fund selection. Are the investors able to always select a fund that is likely to do better than the index? What tools do they have? Now, how will you predict how a fund will perform? There's no such tool. See, you can predict how, to a large extent, you can hold views on how stocks will perform, how sectors will perform, because these are based on your understanding of the sector, the company, its management, its products, the market, and so on and so forth. What tools will you use to determine how a fund manager will perform? None, right? It's really nothing. You'll only go by the past performance, correct? But past performance is not an indication of the future. So when you go into active investing, you're pretty much going with what do you call a blind faith or a view that the past will be replicated in the future. That's the first risk you take. So you take a fund house risk or a fund manager risk or a view that somehow you think that this fund house has the ability to do better than the index, based on what you've seen in the past. That's the first thing you do. Then the second thing you do is, because you have only past performance to look at, this is known not just in India, internationally it is true. Investors buy past winners. So any fund that has outperformed the index will see fund flows, because you're looking at the past performance. So what you will do is, every time a fund has done better than the index and has posted an outperformance, fund manager has selected, made some sector combinations, some stock combinations that have turned out to be winners, and the fund is at the top of the ranking, it will see a lot of new investor money coming in. Now, when you see this, you will find that we call this as the winning fund phenomenon, or the winners, the past winners tend to receive a lot of money. Now, what is the rule of our averaging? Fund that outperformance, or if there is an outperformance for some period, then there is going to be an underperformance in some period. So there have been situations where investors have come into funds that have outperformed, sometimes come in much later, and then found that they are stuck with funds that subsequently underperform, because this is a completely random event. So that is really the case for passive investing. Unless you have tools for selecting funds and unless you get it right every time, very unlikely that your fund portfolio is made up of winners alone. You will have some winners, you will have some losers, you will earn an average return, which is the index return. So that's the case for index investing. So if you invested in an index, you're going to have, the what do you say, the average anyway at a much lower cost, because index funds are the cheapest equity products that are available in the market. But investors do not do 100% indexing only because they believe that they somehow will be able to select funds that are better performing. This is very similar to the stock market idea as well. And then there are some factors in terms of size of funds, fund manager track records, where it creates this track record. And then we say that, oh, these are the funds that I should invest in. Now, what happens is that your passive investing always tends to provide a benchmark return. And there is always some fund that has done better. There will always be. There will always be a bunch of funds that have done better. So from a choice perspective, from a behavioral perspective, it's very clear in your head that there must be some way I can get those winners, and therefore I should be holding passive, right? Active funds still continue to sell despite all of these, what we have discussed, because investors believe that they will be able to choose a winning fund ahead of its outperformance of the index, right? The case for passive investing is this whole what do you say, the nebulousness of this idea, or the fact that how weakly framed this idea is. So you are assuming that you will select a right fund based on past performance, which may or may not repeat, and based on an excess return, which will average out over time. Therefore, institutional portfolios, long-term portfolios world over, it's only in India that the struggle has been there. World over, invest only in index funds. You say, we don't want to get into this idea of um, passive investing. So let's say a provident fund, an institutional investor, a sovereign fund, many of them will invest in ETFs, or many of them will invest in even India investment. If you looked at foreign portfolio investment in India, to a large extent, it will be driven through ETF-like structures, which eliminate these ideas of fund manager risk. Okay. Now, having said this, let's go to this idea of where we are as far as index funds are concerned in India. Now, why the sudden interest in index funds? Because of the SEBI September circular, very clearly. What has happened is that any portfolio in India, equity portfolio in India, will be large cap weighted, because these are the large stocks, these are available, these are leaders and liquid funds, etc. So what the SEBI circular for flexi funds says is that if you want to be called a flexi cap fund, you must have 25% in large cap, 25% in mid cap, and 25% in small cap. Such a portfolio doesn't exist. There's no benchmark also. Even if you looked at Nifty 500, 70% of it is large cap. So there's very little case to say that it is a case of micromanagement. Let's not judge that decision. But what that has created is that it has created a unique problem of underperformance with this category of funds, which have always been top performers. Some fund houses have reclassified their funds. But if you looked at large cap funds or fund houses, what do they typically do? They will change the weightages, they will change the holdings in their stock, and they will try to outperform the index. Okay. But flexi cap as a category has suffered from this new definition that has been introduced. So many investors find that it is cheaper and easier to be able to invest in index funds. So, which is the truth. So come to the investor's perspective. Why should the investor have an index fund? How much ever, three reasons. How much ever you try, your long-term equity performance will look like the index. So you might as well buy the index. Okay, that's the first case. Okay, you need to philosophically accept that posting returns which are more than the index is just a flash in the pan kind of a thing, or a temporary thing. It'll over a period of time. If you're investing for the long term, if you're investing with horizons of 10 years and plus, which is why you're in equity, you will find that your returns are averaging out in a certain manner. So an index fund is a good way to capture that average. One. Two, you save yourself the folly of trying to select funds and getting into buying into winners. Now, it's also important to remember here, behaviorally, we don't sell losers. So we'll chase winners, but if you buy, and then if you find that this fund is not performing, it's not as if you will quickly sell this fund and go into the next fund that is performing. You're very likely to have to be holding on to them, which means your fund selection may not. So the fund manager may be generating an alpha, but your fund selection may not be generating an alpha. So it's important to remember that your bunch of funds may not be outperforming. So that you run that risk, the fund selection risk. And third, the cost. Over a long period of time, if you're looking at a 10-year portfolio, 25-year portfolio, the difference between 25 paisa and 2 rupees is significant for the value of your portfolio. So those are the cases actually for an index fund. But in reality, practical reality is this, that investors are always looking at funds that have outperformed and somehow believe that I will be able to get into this fund before the others. Okay. And there is also merit, as I showed you in the composition, there is also merit in large cap as a category, which is trying to underweight or overweight clearly sectors which are represented in the index in the manner that they are. I showed you the index composition. So what they will therefore do is that you will follow what we call as the core, satellite, and tactical portfolio. Most investors tend to follow this. Your core portfolio is a portfolio which is your default portfolio. You will invest in these without asking a question. Index funds should feature there. Index funds are beautiful default. You don't know which fund to buy. You do not know what's happening. You can invest in the index because it'll deliver you the beta. It'll deliver you the market, right? So when in doubt, you can choose an index and you can subsequently move your money if you like to. But in your portfolio, if your core is in the index, you continue to earn that beta return in your portfolio. The second is your satellite portfolio in which you're hoping to earn an alpha. You must remember that more and more funds you have there. There are investors who run 20 SIPs in a month. They will be earning index returns. Because you must remember that the more and more you try to crowd it, the more and more it will look like the average. You will have a higher cost index fund. So if you have a satellite portfolio, what you're trying to do is you're trying to do better than the index, which means you're including multi-cap funds, or you're including mid caps and small caps for the benefits that they may bring, and manage the large cap funds where the weightages of the index are modified to possibly deliver alpha. So that's your satellite. Your tactical are your sector funds and the calls that you will take based on what is likely to happen in the market. So your portfolio will obviously have all these three. In your core, holding an index is a low cost and a quick default strategy. So you have money, you want to put it in equity, you will, if you can put it into an index fund, your money begins to start working without your taking this decision on, which fund, what time, and how much, and so on and so forth. So that's a huge benefit of index funds. Lastly, before I take on the questions, you have both these choices. You have an ETF and you have the index fund. Is there a difference? Yes, these are two different distinct products. Now, ETF is a bundled index that's available like a unit. Okay, when you buy an ETF, you're buying a unit of the index. So the exchange has created the ETF, and there is a mechanical allocation that's happening into the index components. ETFs are extremely cheap to buy. You of course pay the brokerage and demat charges, but otherwise there is no fund manager in the as far as the ETF is concerned. It's a product which just invests in an index. ETF as a product is very popular world over. Okay, several ETFs have been created for various purposes. Like we know that PSU dilution led to creation of PSU specific ETFs. So you can have bank specific ETFs. So you can have ETFs of various kind. So these are products that are available and traded in the market. The prices will keep changing depending on where the market prices of these stocks are going. So ETF will trade like a stock. You buy it like a stock, you buy it through the broker, and you can have liquidity issues because it's like buying a stock. So if you bought a stock and then if you have to sell, you need to have a counterparty, right? So you might find that sometimes liquidity is an issue. It's like any other stock. If you bought an index fund is also a low cost product. Most funds offer index funds at 50 paisa or lesser. So it's much cheaper. But an index fund is something that the fund managers will hold. They will replicate the index. So they will have a portfolio which is just the same as the index. So any stocks getting in or getting out will be manually managed. The fund will receive dividends, which is which is an advantage. So the fund will have a total return. Okay, whereas an ETF will not receive a dividend. Fund will receive a dividend, and you will find that the fund will also be incurring costs, and the fund also may hold some amount of cash. Okay, so you have both these choices. There's nothing to say that, oh, this is the best thing to do. You want to capture the price movement of the index stocks, you can buy the ETFs. If you believe that holding a passive fund that is managed is a better choice, index fund, there is not much what do you say, to recommend one over the other. Either one is fine. Before I open for questions, I'll just mention this idea of tracking error. Now, when you're looking at an index fund, the index fund should move in the same direction as the index and behave like the index. Now, if you looked at an actively managed fund also, it will move in the same direction of the index. It may be above or below by a little extent from time to time. The question you want to ask when you're looking at fund performance is whether the performance is skill or whether it is sheer luck. When will you say it is luck? you will measure by how much the fund's return is different from the benchmark return. So let's say you measure this every month. So this month, the index has done 10%, fund manager has done 11. 1% is the excess return. We call this the excess return. Okay. Return over and above the benchmark. Next month, the fund manager has done -1. Fund has done 10. Fund manager has done 9. So this 11 and that 9 have cancelled and the fund managers come back to average. You get it? So what will happen is you measure this excess return over a period of time, and then you see what is its standard deviation. What is the standard deviation? Standard deviation is what is the average deviation from the benchmark. So on an average, if the fund manager is above or below the benchmark by 0.5%, that's the average. Okay. You'll ask, can I trust this? The fund manager says, for instance, I have outperformed the index by 4%. You want to say, is this 4% is not happening every month, right? It's not a constant. This 4% is coming with some risk. That 4% excess return the fund manager is posting is coming with a risk. How will you measure that risk? Standard deviation, right? Or when you measure the standard deviation of this, you find that this 4% is coming with a standard deviation of 20%. You know this already, so you won't trust that number. So that 4% is coming with that's the tracking error. Tracking error is nothing but standard deviation of the excess return. So for an index fund, any movement above and below the index should cancel itself out and the tracking error must be 0. Right? So any chance movement. So if you find any index fund with positive tracking errors, then it's not an index fund, right? It's doing something else. The index funds, any movement above or below the index should get cancelled out. And the standard deviation of these movements, excess returns, should be 0, right? For an actively managed fund, the tracking error will be positive because the fund is hoping to make excess returns. And the standard deviation will tell you whether this excess return came from skill. If it came from skill, it will come with lower risk. If it came from luck, it will come with higher risk, right? So active versus passive is a wrong debate because each one is a different category. One is a core category of fund, other is a satellite category of funds. One is a style which is not taking the risk of fund selection, sector selection, or stock selection. The other one takes these risks and pays a higher cost in the hope that there will be a better return. So that's broadly it as far as in index investing is concerned. I think Sangeeta will open to questions.
Yes, Subha, that was extremely clear that everybody should have index funds. But what is the only problem is that affects the income of any advisor. But last year,
I understand.
last year I have done the investing in the index funds because one did not know where to invest, and the returns have been phenomenal, and of course clients have even booked the profit out of that, and obviously again we are waiting in the liquid funds to again reinvest, because obviously sometimes clients feel that let us at least book profits at some time, we just don't want to just go on seeing the color of the money, but we should have it also booked at some point of time. Okay.
Sure.
So just a personal question, how much percentage of your portfolio would you put it into index?
20% of my portfolio is in index. 20%. 20% only because 20%, which is like default. So anytime I have surplus funds and I'm yet to make a fund selection, we all spend a lot of time looking at fund performances and trying to take a call on which funds. I mean, I invest only in about 5 or 6 funds, not more than that. So you want to be sure that the 5 or 6 funds you're holding are good ones and that they continue to perform, and whether there are any newer funds that you might have missed out, right? So while you're trying to do all of this, you will put your money. So about 20% of my money is always in index funds as the kind of cushion for any of my follies that I select funds wrongly or, and so on and so forth. Yeah. But not more than that, because I do believe that active fund returns are worth pursuing. I don't have 100% index portfolio. No.
Okay. I'll
Yeah.
just look at the questions. So Sharad Gupta is asking how to decide between Nifty 50, Nifty 100, Nifty 250, Nifty 500.
Okay. See, uh, any of these are about compositions, right? What do they include, right? So your Nifty is the large cap leader portfolio. It's the portfolio of the top performing largest businesses. Whereas your Nifty 500 includes, I mean, SEBI's definition itself is that, your first 100 stocks are your large caps, and the 100 to 250 are the mid caps, and 250 and above are your smaller cap businesses. So the further and further you go to include other stocks, you will find that your returns are impacted by the presence of these smaller stocks. Smaller stocks will run up, they will show a great amount of momentum. You will earn a good amount of momentum returns, but you will face problems of business failures. So, but what you will also find is that the weightage of large caps in even the Nifty 500 portfolio is quite high. You can't really avoid them in a sense. So, if you believe that, it depends on where you want your exposure. If you believe you want a large, mid, and small cap exposure, you could do a Nifty 500. I personally would focus on, when it comes to index funds, I would personally focus on the the large cap funds, because I do believe that they are liquid, very well traded, and represent the bigger names. So there is also this whole question of index fund as a choice for the first time investor in equity. Okay. Somebody who's not too sure about the markets, etc. So to such an investor, Nifty 50 is a much uh, safer, familiar product. You know that you're holding the bigger names. Yeah. So
Uh, what do you think about investing into the index fund, means the Nasdaq 100 or Nasdaq S&P 5?
it's an excellent way to have international exposure. See, because if you have to invest in global equity, ETF. In fact, many global funds are investing only through ETFs, because it's uh, some of them do hold stocks, but otherwise, and they hold large liquid stocks. But ETFs offer a very good way to invest in commodities. For example, gold ETFs are very popular even in India. If you want to take a position on oil, you think that oil price is going to go up from here, then, and you want to take a position on oil, it's easier to take an oil ETF position, okay, rather than trying to invest in oil businesses. Yeah, it might be difficult for you to manage such a portfolio. So ETF is a fairly well accepted, easy product to get exposure to global commodities, global stocks, global sectors. Yeah, there are several ETF products that are available. There is a question on what happens to the advisors. See, the advisors' money comes from allocation, not only from stock selection, right? How much should be in equity, how much should be in debt, and whether you're able to generate an alpha for your investor based on that allocation. So, these are phases. For the first time, when the equity fund performance research was published in the early 70s, everybody said that the fund management industry will die, because researchers had said that fund managers are not outperforming the index. So people started asking, index funds started appearing on the scenario in 70s when these sensational research was published. So people said, oh my God, why am I paying money when outperformance will not happen? So, but everybody said active fund management will die. 45 years down the lane, active fund management is alive and well. So, these are morbid fears, that index funds will rule the roost and then nothing will happen. No, index funds will still be a small portion of the investor's portfolio. They're not likely. I mean, the return of the active funds is too luring for the investor to ignore. If a fund comes and says my 25-year return is 23% as opposed to the index's return of 16%, that's like a huge alpha, right? A 7% alpha over a 25-year period. Imagine the difference it makes to your portfolio. It's very difficult to ignore that kind of performance numbers. Whether you would have invested in that fund at that time is another question. But the presence of such returns, such alpha, will keep everyone, very keen to invest in active funds. Active funds as a rule will not go away, but I think index funds were not present in investor portfolios. So I think index funds as a category will now will hopefully significantly enter the portfolios. Yeah.
Uh, Between Sensex and Nifty, which one would you suggest to invest in?
They have a correlation of 99.5%. That's the first point I made.
So it does not
You
matter.
take, it doesn't matter. You take any portfolio of equities, large portfolio, it will look like the index. That's why the index, so makes no difference.
Uh, Amongst the funds, because there are many funds from A to Z, every fund has an index or a Nifty fund. Amongst them, you just see which is the one which has a least expense ratio and choose that fund.
That's right. Expense ratio and tracking error.
Okay. So tracking error also, what do you see it on a
Yes,
rolling
you can see
return?
it you can see, you can look at the tracking error over a long period, 3-year, 5-year tracking error numbers, and see whether the fund is actually an index fund or is it, behaving very differently.
Okay.
Tracking error, as I said, is excess return upon its standard deviation. Okay. So whatever is your the standard deviation or whatever is your excess return, you will look at its standard deviation and you will find that the average excess return should be 0. So the fund should not have whatever excess returns it had in some times should be cancelled out by underperformance, and overall the fund should look very similar to the index.
Okay. Uma, can you see any further questions on your receipt? Because you saw some question which I could not see.
How to decide between Nifty?
No,
That question is there. In the chat, there was that question.
Yeah.
Vijay Thakur had asked the question that if going forward, there are no other questions I see in the chat.
Okay.
Right. So that's where we are. And, not a product category to ignore. And it has not been popular only because there's no incentive to sell it. Yeah. These are
Yes.
products which are, there are no incentives to sell this product.
Hmm.
Even to the fund house, it makes sense to sell active funds because that's where they earn their fee, right?
Right.
So it's also the market forces, so to say. Typically, institutional investors are the ones that invest in index funds. I've always said that through all of those struggles of the NPS, you just made the simple decision of investing in index funds. That would have been that, instead of doing all this selection and this and that. Anyway. Institutional
So,
investors world over tend to have index funds. I think PFs also invest primarily in ETFs and index funds. Insurance companies
I think
also invest in index funds. Yeah.
so. I think
Sorry.
even the FI money which has come in, so that all has come in an ETF only. So I think
See, there will be India-specific ETFs. Like
yeah,
a
India
lot of
specific.
India-specific ETFs that have been created and floated for the benefit of FIIs. We're not talking about, what do you say? We're talking about institutional FIIs, which are these pension funds, sovereign funds, and all of them. Many of them will choose to invest through ETFs, which is also the reason why if a stock is doing well and is not in the India index, then you might find that the stock is not in the FII portfolio. It's not attracting FII money. If you remember, we've had when this private sector banks started taking off, you remember we had this huge issue of FI money flowing into banking sector ETFs because they were hugely sought after, and there was a liquidity problem that we had, and huge amounts of money were in the banking sector ETF. So ETF is a very convenient structure for several institutional investors, particularly when they are in unfamiliar markets. While it's true for FIIs with respect to India, it is true for Indian portfolio with respect to foreign markets as well. What percentage of tracking error can be ignored in selecting an index fund? Okay. Now, it's difficult to put a number to this, but broadly, the idea is that not over 0.5%, okay, of tracking error. Uh, that's just a thumb rule, okay? That's not cast in stone. Because there will be times when there will be tracking error coming from index changes, modifications to the index, etc. And sometimes it can come also from dividends. Okay, dividend, depending on the dividend yields, the dividend yields that are there will be tracking errors to that extent, but funds will hold cash. There will also be expense ratios. Okay, for the dividend yield, there is an expense ratio as well. So 0.5% to 1%, not more than that. And as we said, the tracking error must become zero. Okay.
I've seen positive tracking error also for a very long period of time also.
Yeah, that's a problem. But you need to see that its standard deviation is not high. Otherwise, you're taking on needless amounts of risk. There is another question from Sridevi. Good to see you here, Sridevi. There will be an advantage for institutional investors over retail investors. Yes, absolutely. ETFs are also subject to liquidity issues because they are in the stock market. Okay. So these creation units, there's this whole idea of having these creation units that have been done by the index management firm, and then they are available for purchase. So purchase and sale. So if an institutional investor is not on the counterparty to buy, you may face liquidity issues. We haven't had any crisis of that kind in the Indian markets yet, but from a technical perspective, yes. Somebody was asking a question about Nifty 500, etc. So I would assume that larger, broader indices of those ETFs might be less liquid as compared to ETFs that are made up of large cap, well-traded businesses. This is just a conjecture. I have no data to back this up. It's just a conjecture that given the nature of the market. Yeah.
Uma, somebody is asking, mid-cap investing, is it better to have active or passive funds in the Indian context? So it is the...
What is that?
Mid-cap investing, yes.
Okay. For a stock to be in the index, it needs to be liquid and well traded. Okay. So an index stock is a benchmark stock, for all you know. But since stock selection is a big deal when it comes to mid cap, okay, the possibility that a fund manager will make an excess return is higher, or the risks that there will be an excess or a deficit is higher. Okay. In all of these cases, the point that I made holds true. If you don't want to make a mistake of choosing the wrong fund, index is the best thing for you, right? So, but these are two distinct products. It's very difficult to say, no, an index will do better than the active fund manager. There's no such data to back it. So if you believe you cannot select the right fund, choose an index. If you believe you have the skills to research, select and monitor an active fund, choose an active fund.
Okay. There is a member who's asking the new PE norms from April 1st. Will that impact index as a group?
I don't think so. But we wait. We'll talk about it once we know what the final format is.
Achha, as group P is going to be taken rather than individual company.
These are averages anyway, so it shouldn't. But I'll wait rather than make a comment at this time. Yeah.
I'll just see this. Now, would you like to add anything for the members to take the right decision? It is better. It's right. It's good to take a right decision rather than decide on what is the remuneration that we are making as mutual fund distributors.
See, it might also be a cushion for you. You see,
Yes, yes.
um, it might also offer a cushion because if you're having 100% active portfolio, then the whole onus of fund selection is on you. What funds you recommended and what funds did well, what funds did not do well, you see.
Hmm.
So if you also believe that a certain amount of cushioning, a certain amount of averaging is good for your business, then you should have some amount in passive funds. Okay. Because even if you made any mistakes in fund selection, the presence of the index will um, create a averaging effect in the investor's portfolio. That's one thing. Then the second thing is dealing with behavioral limitation of the investors. Many times, the presence of choice makes it difficult for an investor to make a decision. So, having a default choice is always helpful. Okay, having a default choice which you don't have to talk about, which you don't have to sell, which you don't have to justify why you're recommending this over the other. In index as a default choice, you don't have to have too much explaining to do. You know that the investor has cash, you know that the investor is not making up his or her mind. Having a default product will mean that the investor has at least started participating in the market. So it helps with those behavioral issues. It also helps in rebalancing the portfolio. See, every time a portfolio is rebalanced, you sell off something and you have to buy something. Now, this decision is you have to make two decisions now: which one to sell and which one to buy, right? So, and sometimes you have a losing fund that the fund investor is not, willing to sell off. So, there are typical rebalancing problems that we face in advisory profession with the investors. Presence of an index fund will make this easier, where you will make the switch into the index fund and say that let's keep this in the index and wait, let's watch which is an appropriate time to invest in. So there you haven't taken a call, but you have at least kept the investors money from moving away or from getting out of your portfolio, you know
Yes, right.
so you can keep it like the cash component or the liquid component where your return is lower but the AUM remains.
Yes.
Yeah.
Okay. Thank you. Thank you so much, Uma, for your time.
Thank you.
And I'm
Thank you,
sure
everyone,
that,
for coming
yes,
in. And thanks, Sangeeta. All
yes.
right.
Thank you so much.
Yeah.
Okay. See
All
you
right.
next month.
Bye.
Bye
Bye.
bye.
Sure.
Bye.
Bye.